On today's show, you'll hear investor perspectives on the COVID-19 impact on the cannabis market. This is Investor Perspectives. I'm the host of Investor Connect, Hall T. Martin, where we connect startups and investors for funding. It's the time of COVID-19. Cannabis is currently gaining regulatory approval across the U.S. The lockdown has declared certain sectors, including cannabis, to be an essential service. We have investors and startup founders describe the impact of COVID-19 on the cannabis market. I hope you enjoy this episode. My first guest is Tibby Erdely of Key Investment Partners. Great. And so did the lockdown change your investment thesis going forward in the future? And if so, how?
Yeah, it's a great question. So at Key Investment Partners, we certainly pride ourselves in being able to look at investments opportunistically, take a look at deals side by side to figure out where we think that the best risk-adjusted returns are today. So number one, to answer your question, yes, it has changed our investment thesis slightly. Key Investment Partners, we are primarily focused on the ancillary, call it picks and shovels of the industry. So our sweet spot is really kind of this tech play that I'm describing right there. So these business services. However, we have had some appetite in the branded product space in the past. We simply thought pre-COVID that it was just too soon to invest in branded products, given some of the dynamics that I mentioned earlier, right? Every state's its own cannabis ecosystem. Within each state, you've got hundreds of different brands with hundreds of different SKUs. We're traditional private equity investors. We come from one of the largest private equity firms in the world, Partners Group. And we were always taught to invest down the middle of the fairway. This is an industry that's growing rapidly. So what I'm saying is we don't like the idea of throwing darts at a board to try and find, the next Coca-Cola of cannabis. We always viewed it that it would be a space that needed to consolidate before we got comfortable with making an investment in the branded products. Because of COVID, because of some of the dynamics that I mentioned earlier about the consumer really sticking to what they know, what we are starting to see is, and the data suggests that the best brands today are really starting to pull away from the pack. So while I would have probably said to you pre-COVID that we were maybe 2 or 3 years away from making an investment in a branded product, I certainly think that timeline has accelerated quite rapidly for us to the point where we are now starting to take a hard look at quite a few branded product plays at this point in time. So our ancillary investment thesis remains intact. In fact, I believe it remains stronger now, but we've broadened our horizons now to looking more at branded product plays. And I think what's interesting, just kind of round this out, the cannabis industry is, it's certainly one that has these tailwinds that I described behind it, but it's also one that can't hide from the broader cap markets environment that we find ourselves in. A lot of these companies in the space have been raising rounds at what we frankly believe at Key have been some pretty unjustified valuations, being led by some investors that maybe see the growth of the industry, but aren't really taking a look at the fundamentals of the company, which is really what we focus on at Key. Fast forward to today, COVID has made it really tough for a lot of these businesses to raise capital. A lot of these businesses have previously been operating under the assumption that growth over anything else is really the way to go, as they have this big kind of greenfield opportunity, this land grab in front of them. COVID has changed a lot of that perception. A lot of these companies now realize that, holy smokes, I need to focus on profitability. I need to focus on finding efficiencies. So we're seeing a lot of these companies change the way that they're going about operating their business, which we view as a positive. We've always been looking for the companies that are focused on becoming profitable, not just growth over anything else. And then because capital is so hard to come by today, we're seeing valuations start to come back down to earth. We're seeing deals come by that previously we wouldn't have looked at because we just thought that the valuations that they're asking for are astronomical. We've seen quite a large reset in valuations. That will continue to trickle down over the coming months as we continue to, kind of go through this tough environment that we find ourselves in. And then on top of valuations coming down, what we're starting to see is more downside protections introduced in the terms of these deals. So I've seen anything from personal guarantees, which frankly, that's one of the more difficult protections to underwrite, but it does give a good testament to what the management team is looking to accomplish and their confidence in their product or what they're building. But we're also seeing a lot of, call it, discounts to follow-on financing rounds So between valuations coming down, downside protection, and companies starting to focus more on profitability and efficiencies rather than growth over anything else, I think that this is going to be a pretty significant shift in the cannabis industry. I think that obviously COVID is terrible, but this is going to be a very unique point in time. It's going to be looked back on, in 5 years or in 10 years from now as being that shift that really took cannabis to the next level. We like to think that this is really going to be the cannabis 2.0, if you will. You've got this kind of dot-com bubble reset in valuations that started late last year with the crashing of the public equities, with the vape scare. And then you couple that with the cap markets environment that we find ourselves in. And then now you have these businesses that realize that they can't just spend money like crazy. They need to focus on finding efficient, profitable business models. I think that this is really going to be what truly institutionalizes cannabis investing, and it's going to open up a wide range of new investors into the space as well.
My next guest is Scott Greiper of Viridian Capital. Great. So based on COVID, have you updated your investment thesis for the cannabis industry? And if so, how?
We have, and I don't think it's strictly based on the impact of COVID. I just think it's more based on the maturation of the cannabis industry and the restructuring in the industry we're seeing now was really driven before COVID. In late Q1, Q2 of last year, 19, we started to see a sell-off in cannabis stocks. We started to see cannabis public company stocks decline. We started to see valuations decline. We started to see companies have to sell off assets and lay off people that were not core to their business. The cannabis industry got too big too fast. There was too much capital available, particularly the public companies. As a result, they didn't operate in a lean fashion. They got overextended. They were acquiring everything that wasn't nailed down, and they got overvalued. So we're on the other side of that curve now where capital is not quite as available. Investors are only funding those companies that are investing in their core business, not in a business or a technology they bought in, Colombia or Europe, but focusing on their core business. So what are we seeing as a result of that? A couple of things. Number one, public companies are attracting the majority of investor capital. And that's a result not only of the impact of COVID, the decline in the general, public markets, and the decline specifically in the cannabis public markets. There's an adage that when you have fear and uncertainty, the world we're living in now, investors flee to security and they flee to liquidity. It's exactly what we're seeing in the cannabis markets now. Because public companies and the larger public companies have good trading volume in their stocks, they have a much better ability to raise capital because they're offering public stock to the investor, which is liquid, meaning it could be bought and sold versus an investment in a private cannabis company. The impact of COVID and the general crisis that the US and the world are in, more and more capital, the majority of capital, is going to public cannabis companies. So we've changed our investment philosophy from only working with private companies from when we opened our doors in 2014 to the middle of last year, primarily because the public companies were so overvalued, so extended. We didn't feel it was where we wanted to position our investors. We found much better opportunities in private companies. Well, with the public stocks so beaten down, the valuations of the public stocks are not that much above the privates now, the private cannabis companies. So we'd rather move our investors there. Number one, because those tend to be better, more mature companies. They can attract more capital, but also they have liquidity. That's been the primary impact on Viridian's philosophy and the way we advise both our investors and ourselves in terms of working more with public companies than we have in the past.
Well, it's good to hear. So in the last few minutes that we have here, what else should we cover that we haven't?
Well, I guess one of the other major changes we're seeing is in the type of investor capital that's coming into the industry, because it's also representative of an industry that's maturing. So we opened our doors in June of 2014. When we started the Viridian Cannabis Deal Tracker, which was in early 15, almost every investment transaction, capital markets transaction we recorded, analyzed, and reported on was some investor group buying equity in a public or private cannabis company. Common stock, preferred stock, very little debt, very, very few loans. Well, that's changed in the last year. We saw a flurry of debt come into the market beginning in Q3 of last year and continuing through Q1 of this year and even into Q2. So why all of a sudden are lenders, and some very large lenders, that are less concerned about making money on the stock in a cannabis company and more concerned with getting their interest rate, their coupon paid off every month, every quarter of a year, and getting their money back at the end of the term of the loan? Why are they here now? Well, they're here like they're the reason they're in every other sector, because there's companies that are producing consistent revenue growth, consistent profits, and consistent cash flow to pay the interest on the loan and to pay off the loan at the end of the term. And that's what's happening in the cannabis industry. You're seeing very, very large lines of credit, straight debt, convertible debt from $300 million on down being loaned out to cannabis companies. Because these companies, now that they're 3, 4, 5, 6 years into their operating tenure, they've scaled to the point where they're producing consistent, visible, predictable revenue growth, and they're producing consistent, visible profits and cash flow to pay off that debt. This is a major shift, not only for the lenders, but for the cannabis companies themselves. Because debt on the balance sheet can help drive returns. You're raising capital that's not dilutive to the shareholders. That's the key advantage for debt for any company, cannabis or not. But prior to about a year and a half ago, those companies or some subset of the cannabis companies were not scaled enough to attract debt. They were too small, they were too choppy. Even in a high revenue growth environment, they were not profitable. That's starting to change. And it's representative of an industry that's maturing.
Right. And what do you think we'll see next year? Just more of the same, but at bigger dollars? Or do you think we'll see more companies, or all of the above, given the growth rate of the sector?
Well, I think that answer is determined by what happens on November 6, 2020, the presidential election. I don't think it's news to anybody that the Democratic Party is at large has a much more friendly and aggressive perspective to decriminalizing cannabis, to legalizing cannabis at the federal level, and to really opening up this market. Because as quickly as the business of cannabis has grown, and it is, despite COVID, despite a recession, the business of cannabis, the sales of cannabis in legal states continues to grow. In fact, grew at an accelerated pace, as you know all, through COVID, because so many states deemed it an essential good. If the Democrats win in November, you're going to see in 2021 an unfolding of this industry because of the unwinding of the Controlled Substance Act, of the Schedule I status of cannabis. It's going to open up the market principally to the big investor, to the institutional investor, that has stayed out of the market at large because it's illegal. And it's difficult for large investor groups to invest in a federally illegal industry. So the answer to your question is really going to be seen by what happens when people go to vote in the presidential election.
And my next guest is Ryan Dean Hogan of Moda Ventures. And so based on what you saw during the pandemic, what changes did you make based on that? How did you evolve your direction or forecast based on that?
That's a really good question. It was tough. It was moment by moment and analysis of the business. And I think where we are right now, especially because we're seeing closures in Florida and California, Arizona. So we're planning for another spike of sales. Typically in e-commerce, we see no matter what product you're selling, we see the summer months a little bit down where consumers are out enjoying the good weather. They're doing other things. So we've really fortified our supply chain, making sure that we're able to handle increased demand that will be based on probably more aggressive projections than I already had. So that, and then focusing on more product development, not letting the day-to-day of the business get in the way of focusing on our product development strategy that we were focused on before the pandemic began.
Well, great. Well, there's quite a few companies in the CBD space. You foresee any consolidation coming up in the near future?
I think so. I think there will be consolidation. There's a lot of small players in the under $5 million range, and it just comes down to who can acquire the most customers and who can ramp quicker. But that is one of our strategies at Moda Ventures. We are looking to acquire other CBD brands in the U.S., but also Europe. Europe is of great interest to us, primarily because 99% of our sales right now are in the United States. I think the pandemic has showed us that there's a lot of consumers that are still learning about CBD, that they're on the sidelines and they've been introduced to CBD, but our real growth as Moda Ventures is going to be in Europe. And one way that we will enter those markets, pushing the EU, is through acquisitions.
Great. And you talked about acquiring companies in the near future. Which ones do you think are going to be the ones that are going to be the most valuable to acquire? What do you look for in the ones that you want to bring on?
So I think in the CBD space, I think, it's similar in cannabis, but there's a lot of brands that tout their farming capabilities, their extraction, their product, their unique value propositions, which is really important. It's important. I've been a user of CBD since 2014, well before I was in the business of CBD. So it's important that we have a quality product, that it meets our specifications, that our clients are using and consuming the product properly. But I think what we really look for are brands that are able to acquire customers. So brands that have a customer base, they have subscribers, and I'm not saying it's easy to manufacture CBD, but I think it's even more difficult to acquire customers right now. It's expensive and it's very risky. So yeah, we look for brands that are able to, create, at least small free cash flow, but have a customer base and, probably in the revenue range of, greater than, 1 to 1.5 million US a year.
Great. And so in the last few minutes that we have here, what else should we cover that we haven't?
Well, I think that, the CBD market, which is where we operate, I think that the pandemic, when the dust settles, I think it will be good for consumers because they will be able to realize the long-term benefits of CBD. So I think the education and, people spending that time and reflecting on what's important in their lives and what natural health products could help them, I do think that is good for the CBD business. And I think as a CEO of a company and our team, I think our experiences and the difficult times, the good times we had during the pandemic, when we were still already analyzing, what we did, what actions we took, we'll be able to learn from that. And then, we'll see something like this again. Hopefully it's not a pandemic, but both of us, we made it through the Great Recession. We've got this pandemic, something will happen again. And I think these experiences just make us stronger as executives.
My next guest is Ford Smith of Ultra Native.
I think it's really interesting some of the data that's coming out around CBD, cannabinoids and terpenes helping with, helping, I'm not going to say treat the virus, but having interesting impacts on symptoms that are occurring via the virus. I think, it was folklore and conspiracy 4 months ago when you started seeing, articles going around, Facebook, wherever else, kind of suggesting this. And now you've got, just a few days ago, Forbes released an article kind of touching on some of these points. So I think that's something that I hope to see more research on if it is valid. I think that's just, I think that's helping push the movement of cannabis and really, once again, legitimizing it in the eyes of, Americans in the world that this really is a true medicine.
And what were some of the observations? In what way did cannabis or CBD impact someone with COVID? Did it relieve the symptoms? Did it improve antigens? What was the initial findings or hope to find, I guess, is what we were looking for?
It seemed to relieve the symptoms. I didn't admittedly, I saw this a few days ago and then somebody sent it to me last night and I hadn't read much, but I've heard chatter within the community. So I couldn't actually touch on that specifically.
Okay. Thank you for joining us today. As always, be sure to leave a review, subscribe to this podcast, and share it with others. Let's go start up something today. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall in podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.